Thank you all for joining me. I hope you had a great break over December and the new year, and looking forward to an exceptional year in 2026. Getting on to the presentation. I think just really summing it up, it was a good year to be invested. We did have some volatility over Trump in early April, but that was very short-lived, and the returns were very satisfactory. Looking at some highlights of Centaur to keep you updated. Centaur is now over 25 years, and we're a leading boutique asset manager with exceptional returns over that period. In fact, our early investors, our founder investors, are up over 69 times since inception. The business continued to grow. We're a retail-only asset manager, and have 13 billion of assets under management. That represented growth of 18% over the year. That's strong underlying performance and also net flow of funds. We launched the Centaur BCI SA Equity Fund just over 2 years ago. We were positive on South African prospects, and when we launched that fund, we said we expected returns of over 15% per annum. We've delivered returns of 23% per annum, and that fund has surpassed 1 billion of assets under management. So very happy with that. We look for consistent long-term returns through the cycles, thereby ensuring client trust, and a sustainable retail franchise. We also had 2 new appointments, building a stronger team for sustained performance and facilitating growth. Can you just hang on a sec? This thing's not, I just need to change the screens as, yeah, it's not moving. Why is this not moving? I don't know. There. Oh, there we go. Sorry about that. Looking over the year for the flexible fund, you've made money and really some good medium-term, particularly good medium-term returns. So looking over the year, off a high base, we returned 14% below benchmark, but I think we look to outperform over the medium term. And over 3 years, 18%, 5 years, 15%. And you can see the category rankings very strong over 3, 5, and 10 years. Since inception, our first investors, this fund's been going for over 21 years. If you invested 1 million rand at the end of last year, you would have had 21.5 million rand. So really exceptional performance and really showing you how that compounding comes through over time. The Balance Fund, a very similar story here. So 1 year solid returns at 13% below benchmark, similar to the Flexible Fund. 3 and 5 year performance very strong, and category rankings over the medium term, 3 years plus, very, very strong. Looking at performance since inception, the fund is up almost 4 times, outperforming the benchmark at 3.8 times. We've set a very, very difficult benchmark, and also very difficult to replicate because it balances each day. So we are gratified with this performance. We launched the BCI SA Equity Fund on the 30th of November 2023. We were positive on the outlook for SA. We saw some underlying positive momentum that started to manifest this year. We had exceptional returns from bonds, really as South Africa was re-rated. This fund has delivered returns of 23% per annum, marginally below the benchmark. The reason why we have not been in gold, which has been a very strong performer. Nonetheless, you know, our early investors are up over 1.5 times in a relatively short space of time. We still remain very positive on this fund. We see valuations relatively good and still potential for good medium-term returns from this fund. You know, I think the biggest concern for an investor is losing money. So investors don't invest because they don't want returns. They really fear losing money and don't get on board. And we think that fear is very rational, but we design our products really to take that in account. So we've got a very disciplined, valuation-driven investment philosophy. That doesn't mean we won't buy higher P stocks, but we're very cautious of expensive stocks because those are the ones that hit you. So if we're buying something, let's say on a P over 20, we need to be pretty certain that the growth will come through over the medium term to validate those the price we pay. And it really focuses on avoiding loss and then compounding works its magic in the medium term. These risks are managed over the medium term, not short term. We're very cognizant of avoiding noise, and that requires a lot of discipline. Diversification, we employ extensively. This is the ultimate free lunch, and really works over time. And I think this requires patience and really avoiding the institutional imperative, where sometimes people flock to a certain sector. It really requires a lot of discipline not to do that. I think the result is that capital survives downturns and compounds meaningfully over time. So just going further on this, let's look at the worst period over the last 25 years at Centaur Asset Management. We've had a number of downturns. You can think of COVID. That was a very quick downturn, but recovered before year end. So even at the time, it was traumatic. For people's financial health, it was not a long-term impediment. So the worst period was May 2007. If you can think of that period, it was the Mbeki area. South Africa was growing at 5% per annum. Commodities went through the roof as China's growth came through, and there were shortages of key commodities. But underlying that, not everything was perfect. So the first storm clouds of the global financial crisis, which emanated from the USA. And then also in January 2008, you may remember load shedding hit us. That was particularly bad for South African portfolios. So if you invested in May 2007, it took 2 years, 1 year, 9 months for that to fully play out. The portfolio would have dropped 35%. But at that time, there were exceptional opportunities. And what we did at Centaur is we used our systems really to capitalize on the best opportunities with the most upside. Just to give you an example, at that time, we bought Coronation at around 4 Rand. Within 7 years, we sold that at a 25 times profit. Those are the kind of opportunities that manifest during times of crisis, and we exploited. Then the story, at that time, there was a massive recovery. So if you invested in May 2007, 2 years, 9 months later, you're back to square one, no losses. But after 5 years, you would be up 50%. So by holding, stomaching the downturn, you made money. But if we look longer, let's say 10 years since the start, the story is much better. The initial investor who put in 1 million would be up to 3.4 million. So that initial downturn really was forgotten. And really, at that time, we were actually not looking to take on new clients. We realized the market was frothy. And I personally can't recall a single investor who has lost capital investing at Centaur. I think looking at our performance, our asset allocation added a bit of incremental value in the flexible fund. We were overweight SA equities, which was the best performing asset class. And we also caught bonds. Offshore was slightly disappointing, but it is volatile. But probably underperforming by about 2% the benchmark. That's not material, and is volatile because we do employ stock picking. So looking at the SA equity component, and we've taken out gold. So gold exposure has been an approximate 15% drag on relative performance. We had no gold exposure. Over 2 years, excluding gold, our SA equity composite has outperformed the benchmark by 6% per annum. And you can see that in medium-term returns. 3-year returns are actually still very good. For the year to end December, we'd outperformed, in 2024, we outperformed our benchmark by 10.5%. Last year, we marginally underperformed. We don't think this is really cause for concern. Some of the reasons, 2 of our largest stock picks are disappointed, but one of them has already started turning quite dramatically. Also platinum, we had platinum exposure, but we went into the year with slightly underweight there. We did pick up the exposure to platinum later in the year, so we're not underweight there anymore. So that's really the reason for the underperformance. We have been here before. I think it's very important that we stick to our own game, play our own game. That will come through in the medium term. Just looking at the top contributors and detractors in the second half of last year, we were overweight banks. So you can see both ABSA and FirstRand delivering 42 and 24% respectively. Very strong contributors to fund returns in the second half. This is for the total flexible fund, just to give you context. Also platinum, we were marginally overweight. We had 2 key companies there, Valterra, the old Amplats, that was up 80%, and physical platinum, we actually bought that in late 2024, and that was up 41%. On the detractors, Exor, that's a holding company, disappointing. One of its key holdings, Ferrari, lowered its expectations, and that's really why Exor dropped. Also, the discounts widened and also rand strength. Truworths down 18%. We did lighten that in 2024. Nonetheless, we did have a residual holding that was down. And Flutter, that's a share we've largely sold out of. So we have traded that very well. Look at some of the bigger indicators in South Africa. South African government bonds had an exceptional year, down 2%, and the All Bond Index was up about well over 20%. The reasons why SA government bonds performed so well are really a tax boost due to commodity strength. I think there's also been a flow into emerging markets that we've caught the tailwind of this, so our bonds have re-rated somewhat on that. Low interest rates on borrowing are very positive. That also will contribute to a lower deficit in South Africa. There's also been lower issuance of debt, and really they're looking for a potential 10 billion from online betting. We're also starting to see the economy starting to grow better, and that will also boost taxes. So we've seen fiscal debt to GDP climbing. I think it can stabilize, and we may actually see if we can get the growth coming through, we can see that declining, which is positive for our bond yields. Also, the South African Reserve Bank lowered the inflation target to 3%. I think there is credibility. So if they can do that, and bonds at 8.5%, that's the 10-year bond, still look attractive in real terms. Nonetheless, we think bonds are relatively fairly valued. We did have a market weight exposure in the balance fund, and we did have a 10% exposure in government bonds in the flexible fund. So we did benefit from this re-rating. We've shown this graph consistently over numerous periods. What this essentially says is when interest rates drop below a certain inflection point, equity markets start performing very well. We did raise equity content already in 2024 because we anticipated it, and equities performed exceptionally well. So the prime rate now is 101.5% off its peak, and we expect further cuts later this year, possibly another 0.5%. And what this is saying is it's a very good time to be overweight SA equities, and this is how we are positioned. Also looking at SA equities, even though they performed well last year, the forward P is below the 20-year average at around 10.5 times. That's a 15% discount, so not overvalued and further supporting our overweight position. The Rand, this is a very busy slide, so let me try simplify it for you. So if you can look at the period prior to 2013, that's when the Rand was an investment grade, and that really traded at fair value, around fair value. You can see, and the fair value there currently is 1377. In the Zuma era, so Zuma came to power in 2009, there were a lot of signs that things were turning worse, and the markets and the Rand started depreciating. So you can see from about 2010 to 2016, it went from around 6 to 16 in exceptional depreciation, and the Rand, our sovereign debt rating, was downgraded to speculative grade. So the Rand traded an average discount of about 20% to fair value. We do see a lot more positives in South Africa. We've been highlighting them. We think just the regime is a lot more predictable and a more pro-business environment. So the Rand has re-rated. So we see the fair value between a 0% discount, that's 1377, and a 20% discount of 1721. We think the Rand's going to remain relatively strong within that range. I think the one caveat here is the political environment is still quite fragile. So, if when Ramaphosa goes, the next president, and let's say the ANC starts losing power, things may get more difficult. So I think still some caution is required, but and that is really why we have offshore exposure to mitigate those kind of risks. But just summing up, we do expect the Rand to be resilient in that band. Looking at the positives, I think there's a far stronger and more predictable policy framework. I think Ramaphosa has taken a very long time. It has taken time to stabilize things, get the confidence of executives. I don't think there's so much negative self-speak from South Africans, a lot more confidence in the country. I think that's very positive. Also, Operation Vulindlela has resulted in some self-help reforms, particularly improved rail and port performance. It's early days there. There is good upside there. Also, I think remarkably, we exited the FATF grey list in almost record time, around 15 months. I think that really shows you the urgency that it was approached, and I think really kudos to the authorities to do that. Also, we saw GDP growth pick up in Q3 2025 to over 2%. I think there is scope for GDP to start surprising on the upside. There's a lot of positives coming through, and we'll start seeing that in GDP growth. The export basket is exceptionally strong. Gold and platinum group metals and oil prices are weak, so our terms of trade are good. That's also underpinning the Rand. Also, it normally takes about 18 months for interest rate cuts to manifest. We're now in that period, so we'll see those benefits coming through this year, possibly better credit extension to the private sector, and also we're looking at further likely cuts in 2026. From an index perspective, I think we've got renewed relevance in the MSCI Emerging Market Index, particularly if Korea and Greece move to the Developed Market Index. I think the big negatives is really politics, really who's going to replace Cyril, and really municipal elections later this year. I think we are reliant on global commodity cycles and global rates, so that does look positive but can change. I think, notwithstanding the positives, there are severe infrastructure weaknesses, particularly things like water in Johannesburg, and that's going to be very, very difficult to fix. But we have seen positives like the end of load shedding. I think BE policies have not been particularly successful and create negativity economically, and still that's an impediment. And I think a big one more recently is really Chinese competition is really undermining key industries such as autos and smelters. I saw something in the business day yesterday. I think 40% of new car sales are now Chinese. That's really pressuring the South African producers of autos. And this is like an ongoing trend worldwide. And I think our authorities are somewhat oblivious to this threat. Summing that all up, it's a net positive, and we've seen the rand strong, 10-year South African bond yields down, and declining risk premiums, which is resulting in very good returns for SA equity investors. Just looking offshore, we are very concerned about the AI kind of bubble. The reasons why is, ChatGPT, which is really at the center of this, is still a relatively small business, and its business model is unproven. So it's predicted annual run rate. That's if you take the monthly sales and you annualize that, ChatGPT will have about a 20 billion annual run rate of revenue. But it's making very high losses, and it's predicting $115 billion of cumulative further losses to the end of 2030. So that's almost 25 to 30 billion losses a year. And this is really the fulcrum of the whole AI investment cycle. It's leasing capacity from both Microsoft and companies like Oracle. This is resulting in a lot of spend on chips for NVIDIA, and NVIDIA is one of the top 3 largest companies at this stage. So it's really a cycle which is working on itself. Some of these companies are funding ChatGPT's losses, which results in very strong demand for chips. We're not sure if it's sustainable. It has not been tested. So we are very cautious on this. Just looking at the bottom, the Magnificent Seven, those are the companies above Apple, Microsoft, Amazon, Alphabet, Meta, NVIDIA, and Tesla, now comprise 34% of the S&P 500. So that is vulnerable if there is a deflation in the AI trade. So I think we are cautious towards that. Things like Tesla look exceptionally expensive. NVIDIA, if there's a slowdown in demand, that's alone 8% of the S&P 500. That's vulnerable. Things like Alphabet are going a different course. That looks far more robust. Microsoft itself is somewhat reliant on ChatGPT as well. One area we do think exciting is, as you can see, global renewables are now 90% of new power. But these are very unstable, and at times, 40% of renewable power is not used at peak times. Particularly places like Spain, when the sun's shining, there's excess solar electricity which can't be used. And really the solution is battery energy storage systems. These store excess electricity and then release it when demand goes up or generation goes down. So it's really an energy reservoir when the sun is shining, and then it can be fed into the grid late in the day, in the key evening period. We're looking very strong growth in the battery energy storage market. So over the last 10 years, it's grown at 60% per annum. Part of the reasons battery costs have fallen 90%. Systems are far more standardized and 3 times more efficient, and power has become a government policy priority. Also, what's quite important, these battery energy storage systems are generally only about 1.5 to 2 hours. The Chinese do have a roadmap for a full 12-hour storage solution, which can actually power through the night. These are being released in stages, and we think a 12-hour storage solution will be released in the next 18 months. That alone, between a 1.5 and 12-hour energy storage system, is a 6-fold increase in demand. So we see exceptionally strong demand for this. And Centaur, which is a Hong Kong-listed Chinese company, is the #1 global operator with over 50% market share. It has a very strong lead over competitors. That's really due to scale, efficiency, product development, and vertically integrated. It makes a good return on capital, over 35%, and over 100% cash conversion. It's got cash on the balance sheet and 2% dividend yield. And we think profits can go up 4 times over the next 10 years. So we think this is going to be a massive theme over the next decade, a massive growth area. We've taken initial stake, and we will look to further increase the stake in Cattle in time. Just looking at our investment strategy, we think South African Incorporated continues to offer compelling value and good prospective returns. So we remain very overweight. We have not been involved in the gold bull market. We are cautious. So we think it's too late to get involved. If you look at the total value of gold holdings in the world, it's over $30 trillion. So it's a very, very big market. Once it gets tested, I'm not sure if it's going to be able to hold up. We are overweight platinum group metals, but that can change at short notice. That is working well for us at this stage. Offshore, we're recycling offshore into new ideas. We exited most of Flat at good prices. We're looking to fully exit that, and we're buying new companies, particularly in emerging markets. And we also think China's a good area, and we gave you the example of Cattle. Just looking at asset allocation, I've highlighted the SA equity exposure. So you can see in the flexible fund, we've got 58%. Our benchmark 50%, so we're 8% overweight. Similarly, in the balance fund, we've got 48% exposure, 8% over benchmark. So we're overweight there. World equity is slightly underweight. We are cautious on the US, and we are recycling into new ideas. So that is very opportunity dependent. SA government bonds in the balance fund, we've got 25%. That's very in line with benchmark. We are underweight global, so we think the rand is going to be firm, but we'll use that firmness to send more money into euros and dollars. Just looking at the top holdings, both locally and offshore. So banks, that's both Absa and FirstRand, around 7% each. 14% of the fund perform very well. We still think they've got good prospective returns of around 20%. Prosus, we did lighten, so it was up to 8.5%. It's now 6%. We have lightened that somewhat, but still positive on returns. Valterra, that's been a very strong performer, 4% of the fund, and is a key platinum exposure. And MMI Holdings, that performed well. We still think that's good value, 4% of the fund and expected returns of 20%. Offshore holdings, platinum, that came through exceptionally strongly. That was up about 125% in dollars last year, but really mitigates some of the local risk being underweight. Exor, that has been disappointing, but we think at a 4% discount to the sum of the parts. It's got good upside. Dell 3%, very well managed, will benefit from AI server demand. And Trip.com, that's a US listed Chinese company. We're also positive on that. Just concluding, we think it's an excellent time to be overweight SA, and that's how we positioned. Offshore, our preference is very stock specific, but we've got a bias to China, Europe, and emerging markets, and we expect continued good returns from the local market, and we remain confident in delivering outperformance over the medium term. Thank you very much for your time. That concludes my presentation.